Good morning. This is Monty once again from DPL Surveillance Equipment. Good morning, you guys. Almost caught me by surprise there. I didn't realize I pressed the record button. Anyway, let's get started here, okay? Let's see how far, how well we can get into this particular topic. I think it's an interesting topic, interesting podcast, or an article. We always include an accompanying article along with the podcast, so that for those of you who just want to listen in and put off reading for the time being, then that's fine. And for those, of course, who do have the time to read, can start reading right away and such. So let's see, what are we up to today? Just finished wiping down my car, reviewing some things that happening in the economy, the financial markets, and such. Before I forget, it looks like banks. And two things I want to quickly cover. Banks are getting more and more desperate. They're working with credit card companies. They're working with credit card companies. Companies whose specialty has more to do with personal loans, placing personal unsecured loans. And it looks like the partnership between the banks and the credit card companies are the companies that specialize in providing personal loans to consumers are partnering, and the banks are sharing that information with certain companies, and they're turning over a lot of you guys' critical data. Looks like Bank of America, Wells Fargo, Citicorp, JP Morgan Chase, everybody's in on it. And they're sharing your critical information, so just make sure you understand the implications of this, because consumer debt has reached what seems to be peak levels, almost leveling off. Banks are getting more and more desperate because that's it's a decent source of income for banks. So anyway, they're outsourcing out the idea of trying to figure out different, more creative ways of causing consumers to take on more debt. So it's not bad enough that a lot of you are maxed out on your credit cards and maxed out on your debt. You have other companies like Credit Karma working with the various banks to try to figure out ways to get more debt, get you to take on more debt as well. If that weren't enough, looks like also, what was I reading? The banks are finally realizing that because interest rates are going higher. Excuse the noise, got to make some noise real fast. I think this is interesting too because interest rates are going higher, and let's see, 1 second here. Interest rates are going higher. We got that part. And banks are actually, banks have certain customers, different types of customers. They're corporate customers. I don't know if you guys know it or not, but a lot of the corporate customers who place deposits with banks, they weren't earning interest on certain types of deposits, for corporate America. So they would forego the interest-bearing accounts, and these corporations would actually get the benefits of credits from the banks, and that would a lot of times offset the lack of interest from those accounts, if that makes any sense. I'll do an article on it or something so that it's more easy to understand. But basically what's happening now is there's $30 billion that have been exiting the banking industry within the last 12 months because corporations are finally realizing that these non-interest bearing accounts and that they were having at the banks, that they had with the banks, is no longer acceptable in terms of, if interest rates are going up overall in the economy, then a lot of corporations are starting to realize we might as well be making something, right? We might as well move that money out of the banks and move it into higher, riskier investments. So anyway, if you start to see banks' earnings and stock prices fall off significantly, more than likely it's because a lot of these clients are leaving the banking industry and they're going into other investments. More than likely, investments offered by the major investment companies like Fidelity, Goldman Sachs, Morgan Stanley, whoever, BlackRock, maybe something like that. Anyway, money is moving from lower risk places to higher risk areas. So I don't know if that's good or bad, but that's what's happening. Anyway, and then of course apartments, units, the companies who manufacture and manage apartment units, whether it's houses or actual multifamily buildings, those stocks seem to be performing well. So in this economic environment, it looks like single-family ownership is dwindling at a significant pace, while at the same time, you can see, you always want to follow money, you can see that stocks for those companies who, again, specialize in renting out either apartment units like multifamily units or single-family homes. I read that. I think BlackRock and Carlyle Group are putting tons of money into huge projects that have nothing to do with that do nothing but rent out houses on a large scale, houses, apartment buildings, whatever, on a large scale. So the big game in town seems to be rent, share, gig economy, anything but ownership. So I don't know if that's good or bad again, but that's what's happening. Anyway, my name is Monty Henry, owner of DPL Surveillance Equipment. I run a full-service surveillance and security equipment company. We have lifetime guarantees and warranties on all the products. We have 24/7, 365 tech sales and customer support. We have the largest inventory of items that not only can you buy, but you can rent and layaway as well. And we have the largest media center. This media library that we have consists of blogs and demonstration videos and articles and podcasts. And they're all free. They're all educational. We cover diverse subjects in there. We cover health and fitness, economics and finance, cybersecurity, surveillance and counter-surveillance, Bitcoin, blockchain, terrorism, anti-terrorism technologies as well. And there's a miscellaneous category for everything else. We accept Bitcoin, Litecoin, and Bitcoin, Litecoin, and Ethereum, and Bcash in the shopping cart. You crypto millionaires, you may want to stop by our website, patronize the business, get your favorite spy gadgets. They're all lifetime guaranteed and warranted, and they're all state-of-the-art, and they're all law enforcement-grade products. We don't like to do business with the credit card issuers, the MasterCards and the Visas and American Expresses. Those companies are indeed ruining the economy, ruining the retail space, ruining the ability for consumers to have money left over to invest and save. Excuse me. It seems like they've just gone way too far. Those credit card issuers and banks and financial institutions have gone way too far in terms of sucking out all the financial resources out of the economy without offering anything valuable, in return. So anyway, take a look at Bitcoin, take a look at blockchain, take a look at the cryptocurrency space. That's where the growth is. That's where the jobs are. That's where Wall Street talent is heading. That's where talent is going from Silicon Valley and such. Even government officials, a lot of the people from Washington are heading on over to work for companies, even if it's a Ripple, even if it's, you name it. There's all sorts of Coinbase. There's all sorts of people from Washington. They're taking up positions as legal counsel, as investment advisors, as board of directors in the cryptocurrency space. So that's where the talent is heading. And if you want to work, make some big money or whatever, get some mental challenges in your life, go work in the crypto space. So let's take a look at the article for today. The article for today, I might as well preface it for you. The article today is all about financial money management and the ability to focus. Okay, a lot of you are trying to attain your financial goals. You do a lot of planning. You talk to a lot of people about what to invest in and what's hot, what's not, and all that. But a lot of you are indeed going about it the wrong way. Your temperament is not suitable for long-term investing. You got too many distractions. So let's try to figure out how to reprogram your lifestyle so that you can concentrate and achieve your long-term goals. Okay? The name of this article is The High Financial Price of Our Short Attention Spans. Again, the high financial price of our short attention spans. Information overload is giving us little time to focus on any of it and leading us to make bad choices about our money. Digital devices are potentially damaging your wallet, but not in the way you might think. Smartphones and other gadgets allow us to follow our friends, read the news, watch a football game, and even track our investments anytime and nearly anywhere. We're always multitasking or moving from one bit of information to the next, and rarely looking at one piece of information long enough to fully digest it. All this has one crucial side effect. It creates a shortage of attention, which can lead to poor financial choices. When it comes to our money, effective decision-making typically requires information concentration, and reflection. Not so long ago, the main scarcity was information. We lacked the data to make informed financial decisions. But now, we're drowning in data. What we lack instead is the ability to properly process it. The price we pay for that may be subtle, but it's hardly insignificant. Fortunately, it doesn't have to be this way, in part because while the digital world takes away our ability to concentrate, it also gives us tools to mitigate the damage. Here are a few ways we can counteract the financial pain inflicted by our increasingly short attention spans. Avoid multitasking. You probably know that multitasking is bad for your concentration, but you also probably underestimate how bad it is and how much it affects your ability to make effective decisions. This is especially true when it comes to financial decisions, which often require navigating difficult trade-offs. Is the additional investment risk worth the potential reward? How does this investment fit with our overall portfolio? Is now the best time to sell a successful startup? Is now the best time? Such questions benefit from careful reflection, but multitasking interferes with our ability to do just that. For instance, research by Baba Shev and Alexander Fedorikin has shown that asking people to remember a few extra numbers can short-circuit their self-control, making them much more likely to choose a slice of chocolate cake instead of a fruit salad. Why is that? One likely possibility is that we run out of mental bandwidth when we try to remember several numbers and resist immediate gratification at the same time. As a result, we choose the cake, even if we're supposed to be on a diet. More to the point in this discussion, we end up spending rather than saving. In other words, trying to multitask makes us worse at most tasks. The lesson of this research is that the complexity of financial decisions benefits from a reflective thought process so that we can marshal all of our cognitive resources on navigating the necessary trade-offs. Unfortunately, smartphones and mobile gadgets encourage the opposite kind of thinking as we are constantly distracted by incoming emails, texts, and alerts. If you have to make major financial decisions on a screen, you should at least do it in airplane mode or do not disturb mode. Pick the right time of day. Investors need to become more aware of fluctuations in the amount of attention we have at different times of the day. Research by the Behavioral Insights team in Britain, a public-private company devoted to applying behavioral economics, has found that people are significantly less likely to successfully navigate complex websites in the morning. One possible explanation involves our lack of attention. as the morning is full of tasks that take up precious bandwidth, from getting the children to school to catching up on email. If this sounds familiar, then you might want to postpone your financial decisions until later in the day. Of course, you might have calm mornings and hectic afternoons. As a rule of thumb, consider using an app such as Apple's new Screen Time feature that tracks and displays your device usage throughout the day, which could be a very good proxy for your bandwidth. The point is to reflect on your available attention and ensure you are making your hardest choices, especially financial ones, during the lulls in your day, when you're best able to handle complexity. If you're considering selling an investment, for instance, don't hit send on the email instructions to your advisor when you're rushing between dropping the children at school and meeting with your boss. Wait for a breather. Focus on the most relevant information, not the most available. When we focus on the latest alert or the numbers on a single screen, we become subject to what Nobel laureate Daniel Kahneman refers to as the "what you see is all there is" error. This means that people typically make decisions based upon the immediately available information, what we see at first glance, and forget that there might be more relevant information that isn't available. Consider, for instance, the impact of the minimum payment information on credit card repayment screens. Studies show that including that information leads people to make smaller payments, with the minimum serving as an anchor, biasing the amount downward. Over time, this leads to higher levels of debt and more money squandered on interest payments. By taking away the minimum payment information, we can make it easier for people to make better decisions about how and when to pay off their credit cards. In the domain of investing, the error often leads us to focus on short-term results as we fixate on the recent performance of a stock or investment. To mitigate this bias, we should ensure that the time horizons on our financial websites, the duration of performance that's automatically displayed, matches our actual investment time horizons. If we're not retiring for several decades, there's no reason to pay attention to the daily fluctuations of a stock or fund. Research by Maya Shadden shows that after the Israeli government prohibited retirement funds from displaying returns for periods shorter than 12 months, investors reacted by trading less and taking smarter risks with their investments, with their savings. We should also delete the stock app on our phones and think carefully about which financial apps are allowed to send us notifications. If you are properly diversified and you're not retiring for a while, there's virtually no need to stay up to date on market news. Your biggest mistakes will come from overreacting to the latest stock swings, not underreacting. Force yourself to see the big picture. Some tools on our smartphones can actually help us preserve some of our precious bandwidth. Many of us struggle to monitor all of our credit cards or remember how much we've saved, but aggregators allow us to see all of this information. They also make it easy to track trends and spot patterns so we can notice when our spending spikes or when we're falling short of our retirement goals. In short, they help us compensate for the "what you see is all there is" error, since they make it easy for us to quickly notice our most important financial facts. Similarly, there are apps that automatically monitor our finances, pay our bills, set aside money into our savings accounts. Just as your phone remembers the numbers of friends so you don't have to, these gadgets can also perform routine financial tasks, letting us focus on the bigger picture. The typical American probably spends more time choosing a restaurant for date night than choosing a savings rate for the retirement plan. By taking care of these routine financial chores, the apps can free up some mental bandwidth for better investment of time and attention, such as long-term financial planning. Sound like the crows also agree. Keep away from the phone. This may be the hardest piece of advice, given our smartphone-obsessed culture, but the evidence is mounting that we make financial decisions on our mobile device or within earshot of our mobile device. The decisions can very well be bad ones. My own preliminary research conducted with John Payne of Duke University shows that people tend to perform worse on the test of financial literacy when given the questions on a mobile device, at least compared with those subjects taking the same test on paper. One likely explanation involves the tendency of people to think and read faster on their smartphones. As we continually scroll down the screen for more stimulation, and the news gets even worse. Recent work by Adrian Ward, Kristen Duke, Ayet Genizi, and Martin Balls shows that just having your smartphone next to you, even if it isn't turned on, can diminish your cognitive capacity. According to the research, subjects with a phone nearby perform significantly worse on measures of attention, working memory, and fluid intelligence than those whose phones were in another room. The researchers speculate that the effect exists because the mere proximity of a smartphone causes us to monitor it. We're waiting for those alerts and interruptions, and that monitoring takes up attentional resources. This suggests that we should try to avoid using our smartphones or even being close to them when making financial decisions. Here's where a financial advisor can help. During your next meeting, perhaps your advisor should suggest that you leave your phone behind at a charging station with the receptionist. That way, if you get any urgent calls, you can still be notified. Given the impact many financial decisions have on our future and the fact that they are not easily undone, it's worth being disconnected for an hour or so, even if an hour or so. Excuse me. Let me read that again. It's worth being disconnected for an hour or so if it can improve the quality of our choices. So that pretty much is the conclusion of that article. And I just want to reiterate that, the younger people, the digital culture, people who grew up with smartphones and pretty much had internet and all of this abundance of digital and virtual technology all around. You guys are probably really impacted by what this article is saying. Your attention spans may lead most people to think you have ADD. So you need to reprogram the way you think. You need to start focusing on projects and stick to one project at a time, intentionally focusing on one thing. If that means reading an article over and over 5-6 times, that's fine, because you're retraining, you're reprogramming your brains to only consider one subject and one subject only, or one task and one task only for 10 minutes, 15 minutes, 20 minutes at a time. Just practice over and over, because you guys got to reprogram your brains, because you're skipping around from one subject, one idea, one task to the other within a span of 5 or 10 minutes. And unfortunately, your brain gets rewired to a certain extent at that point, and it's not permanent, but yeah, you are going to suffer when you do have to have certain projects and tasks and things that are long-term in nature. Your investment plan, your retirement plan, these things are not short-term. They're not even medium-term. They're long-term. And a lot of people look at news and headlines and press releases about stocks and investments and such, and they can't help but carry over into that space that same bad habit of, I must do something and quickly. Because again, as the article points out, when you get your smartphone in your hand, your brain goes into overload and you start acting quickly, thinking quickly, talking quickly, reading quickly. Everything is quick. So just make sure you understand you have to start retraining yourself so that you can focus on certain things, at least your financial planning and money management. Those skills are not the type of skills that you want to act impulsively on or with. You want to make sure that you concentrate as far as that's concerned. So anyway, as we like to say at the conclusion of every podcast, keep your eyes and ears open and stay safe out there. Have a great day. Bye.